The following is a presentation of TFNN. The Global Market Pulse with your host, John Logan. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, John Logan.
Hi, this is Larry Pesavento setting in for John Logan. As most of you that listen in here to TFNN realize that John had a perforated appendix, and he really got in bad shape. That happened to me in 1956, and I played a basketball game with a perforated appendix. I thought I had an upset stomach, and they didn't have any antibiotics back then, and I almost died because of the infection and stuff. But so I know pretty much what he's going through. But when you go through it, when you're older, it's even harder, because when you're younger, you bounce back, so very, very quickly. Start out the show today to report about the services for Mark Douglas that we had this weekend. There were people from all over the world, folks. I mean, you wouldn't believe it. 100 people showed up from UK, several people from Australia, the hockey team, several members of the 1980 hockey team were there. People from Japan came. It was really amazing. About 40 people got up and talked. This man really affected a lot of people's lives. Unfortunately, I wasn't able to attend because I was here in Philadelphia. There was no way that I could get there because of the Pope being here. There was just no way I could get out and get back in time. So I was in touch with Paula every day, like I am every day, because Sarah and I check in with her every day. Doing better, but she was really moved about the experience. There was really a lot of joyfulness with him being gone, because he really did affect a whole lot of people. Okay, we'll talk a little bit about the markets this morning. The biggest problem that I see it resides across the pond over in Germany with what's going on with Volkswagen, and also what's going on with Deutsche Bank. Both of those things are, I think, going to be outlier events that are going to play out. I think that Deutsche Bank is probably in as big as trouble as Lehman Brothers was back in 2008. So whether it happens that way or not, I don't know. Now, the German government has a lot at stake in keeping DB alive, because it's their largest bank. It's the largest bank in Europe, one of the largest banks in the world. So it's a really important thing that we watch this. Now, we gapped down again yesterday, and we went below $27 a share. Now, what will usually happen with both Volkswagen and with Deutsche Bank, they're going to come up with all kinds of wonderful, glowing reports like, yep, this is a problem, but we're under control, we got it fixed, everything like that, just like we heard with Lehman Brothers and just like we heard with Bear Stearns. So all you got to do is follow the money. If the prices goes down, there's more selling. That's basically the bottom line. So keep an eye on it. Volkswagen was down another 3% today in Europe. And we had a big sell-off across Asia with the Nikkei down 4%. China was down 3%. The Hang Seng was down 3%. And we're getting a bust now here in our futures. We're up about 20 handles off the bottom. Now remember, Sunday night we rallied 20 handles off the bottom before we dropped 50 handles. So we're in a major bear market, folks. The best we'll get out of this is a 2 or 3 day rally, would be my guess. And if I'm wrong, then maybe this market can go up and make new highs. But when you look at this, it's really difficult to find something to hang your hat on to be bullish. I mean, you've broken down some major serious levels now. If you just take a look at the IBB, we took out the August lows. We took out the August lows on the Russell. The only positive thing that I saw on the charts last night was the fact that the Dow Jones stopped at the 786 retracement of the move down from August to 24th. That was the Dow Jones. All the others look like they're flying Walinda. I mean, they really look really bad. Now the Treasury bonds, they went right up and completed an ABCD pattern at 158 last night. That's what really was the start of the rally. The S&P was trading around 1862, 1863 when we completed that ABCD in the bonds at 158, and now they've sold off a point and a half from that level. So that's what we're watching. But folks, don't let anybody sway you the wrong way. Stop, do your own thinking. Take a look at some of these charts and look at them at how bearish they really are, and some of them look just absolutely horrible. We'll look here at the first. We'll take a look at will be the small cap, which is we'll look at the IWM, which is the ETF for the small cap, which is like the Russell 2000 futures. And as you can see, we closed below the lows of August the 25th, and what happened was, we rallied to a 50% off of the high. That sets up a huge ABCD level, going way down to about 95. And we're trading at 108. That means there's another 10% to go in this one, as near as I can tell, looking at it. So that's something that looks, really negative also. Now, if we take a look at one market that we haven't seen for a while, but since it's related to a little bit about what's going on with Deutsche Bank, let's take a look at the junk bond market. And you see that we've had this outstanding target in junk bonds down here, this huge ABCD down here at around 35 to 36, actually 35 and 35 and a half, and we're almost there right now. Could this be the start of a pretty good rally? Of course it could be, but it also could be an acceleration point. So we've got to watch that. But junk bonds have been bearish. They've finally rolled over, and the Treasury bonds, the spread between the junk bonds and the Treasury bonds changed a lot, and that's what you want to see during this type of a market that we're watching here. But that's my I look at it. Now, there's been a lot of talk this morning here in the den, and then also on CNBC. Carl Icahn came out, and he basically said that what the Federal Reserve was doing with quantitative easing was bogus, and that would probably come back to haunt the market. We've been saying that for a long time, and I'm just saying that from common sense, folks. You can't run a household like the Federal Reserve is, trying to run our economy, and I don't see how you can, make it work. But it's worked for assets for 5 or 6 years, getting them to go higher. But we'll wait and see. But I'm of the opinion that this is a giant experiment. When history goes back and look at this 25, 30, 50 years from now, they're going to be saying, what were they thinking? And that's the way I see it from my seat here in Philadelphia. So I don't know. That's just the way I see it. This market looks extremely bearish. I would guess a 2-day rally, 3-day rally at the most. Into Tuesday or Wednesday, maybe the S&P can get back to say 1910 or even 1920 basis December futures. That's certainly a possibility, but the overall bearishness of this is just really beyond belief. When you stop and think what's happened to the stock like Volkswagen. And this is, we've gone below this level here. We're trading down around 23 and change, as I recall. And it's really, a very, very negative chart. Realize that everybody that's bought Volkswagen in the last 4 years is now underwater and without without a paddle, pretty much, because they've they're in some big trouble. They did some really bad things, and they're going to have to pay for it. The question is, how much and how long is it going to take to get it out of the way? And there's rumors about the scandal. The industry goes much deeper in Germany, but frankly, I think those are people that are just short and want to push it to the limit. But I don't know. But that's just rumors and stuff like that. The price of the stock of the Deutsche Bank is also continues to drop. We gapped down yesterday. We got down to near $25 a share. We hit some type of a minor bottom there at 26 and change, but that's basically all it is. And stop and think, folks, this is the largest bank in Germany, one of the largest banks in the world, and they've got problems with derivatives. And that's where I believe many of these big problems are going to come in as a counterparty risk on these derivatives, because there's just no way to get out of some of this stuff when the proverbial what hits the fan. But this is like what happened with long-term capital. But this is a chart that I did, a weekly chart on Deutsche Bank, and it's got down to almost $25 a share yesterday, and so also continuing to go lower. So I just don't feel going higher. We'll get a little bit of a bounce in here probably, but much like we did Sunday night, we rallied 20 handles, and we could rally 50 handles. So we could easily get the S&P back to 1910 on some type of some wonderful glowing news of what's happening in the economy through the Federal Reserve's eyes, and whether that'll happen or not, I don't know. But just looking at these charts, it really is a very, very bearish scenario, no matter how you look at it. Now, one of my friends from the UK attended a meeting yesterday in Paris. It was one of the key speakers was Tom from Nomura Securities. Tom is the fellow who did the study on the new moon, full moon, buy on the new moon, sell on the full moon, over a period from 1928 to the present, and it showed that if you bought on the new moon and sold on the full moon, just doing that, buying on the day of the new moon and selling on the day of the full moon, you outperformed the S&P by I believe 12 times. It was really, really a sparkling report. If you'll take a look at that, all you have to do is to go into Google and just put Nomura. I think all you have to put in is Nomura moon cycles, or put talk PELC moon cycles. You can pull that up on the internet, and it'll give you the whole report. So we're going to take a little break. This is Larry Pesavento setting in for our recovering John Logan at 877-927-6648.
TFNN is excited to offer a brand new piece of market scanning software unlike anything the industry has ever seen. John Logan and his team have spent years developing their market profile tools to finally be able to release the TAS Profile Scanner Plus. And right now you can get a 2-week trial absolutely free just by visiting TFNN.com and providing us your name and email address. The TAS Profile Scanner Plus is the premier market profile based scanner in the industry. Powered by the acclaimed TAS proprietary algorithms, this feature-rich scanner is a standalone desktop software that instantly filters over 2,500 global financial markets such as stocks, ETFs, commodity futures, and Forex. Within 3 minutes of signing up, you can have the software downloaded and running on your computer with a complete roadmap of market indicators and inflection points to trade off using the TAS Profile Scanner Plus. Sign up today and try this amazing piece of software by visiting TFNN.com.
Tiger TV is an exciting way to experience TFNN programming. See high-definition video, giving you crystal clear charts, as well as seeing some of the faces of TFNN's highly acclaimed financial experts with crisp, full-fidelity sound. Catch Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, Larry Pesavento, Think or Swim, David White, Andy Hecht, and Daryl Martin in crystal clear, high-definition audio and video. Tiger TV, exclusively at TFNN.com. Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
Until recently, it was almost impossible for the average investor to hedge against currency risk in Europe or Japan. For a bold trade on Europe or Japan that protects against moves in currency, trade HEGE or HEGJ, 2 times currency hedged leveraged ETFs from Direction Investments. Visit directioninvestments.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction shares. To obtain a prospectus or summary prospectus, please contact Direction shares at 866-476-7523. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com. John takes your phone calls. Now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Okay, we're back, folks, and this is Larry Pesavento sitting in for John Logan today. And the next chart that I'm going to post into Tiger TV is a chart from Tom Pelk's presentation yesterday in Paris, where he was talking about cycles and a lot of different things. It was a very, very long report, 64 pages. It was really quite intense, and he is an incredible young man and a very, very good researcher. He's in charge of technical analysis division for Nomura Securities there on the Thames River there in the UK, and we were fortunate enough to meet him several times when we've been to the UK and go to the offices, but he's a very, very bright young man. What he's showing here is the work that Gann used to talk about, where years ending in 7 were bear years, and he goes back to 1887. This goes through 2007, and it shows that this is where these bear markets happen. What his report was leading up to the fact that we're coming into 2017, so we're topping here in 2015, and he's not looking for a bottom until 2017. Part of the in this report was done by a man named Sam Benner. It was called the Benner Business Cycle, Benner, the Benner Business Cycle. Sam Benner was a farmer in Ohio, I believe, and he had this cycle that he used, and it was very, very popular for a long time. You don't hear much of it anymore, but it is a very, very good cycle. And Tom brought this out and showed the how well 7-year cycle actually worked. And what happened, I believe, is that the Federal Reserve has skewed some of these cycles because of quantitative easing. We haven't gone through a contraction like we usually get, during these times. It's basically just been, risk on or risk off, and they keep pumping money into it, making the economy appear better than it actually is, but that's neither here nor there. Anyway, this is what his report was referring to. He basically said that we've entered a really bearish phase here in the market, and he was looking for higher interest rates, lower stock prices into 2017 is what he's looking for. So whether that's going to be the case or not, I don't know, because remember, everything we're doing here is related to probabilities. It's nothing is etched in stone. That's for sure. Now, I also wanted to talk a little bit about the chart that was posted last year from the Elliott wave theorist, and that was about the where we were with the Federal Reserve and how they'd pumped money into it. And as you can see here, we've gone really ballistic on the upside. It's certainly a parabolic move, and it's gone even higher than that. It's gone way above $5 trillion that the Federal Reserve has pumped into the system. And how they're going to work out of this, we have to wait and see. But this is what quantitative easing looks like on a chart. Believe me, back in the old days, I've mentioned this many times, but if this were 1979 or 1980, gold would be at $4,000 or $5,000 an ounce instead of 1,100 and change. And as a matter of fact, it broke down below the key support yesterday at the 1128 level. We did get down to about 1122 last night, but the it still held. Now I happened to be watching silver last night because I'm interested in silver, and I watched how it acted once it broke the 450 level. And believe me, it didn't break very much. It got down to I believe 455, and it was 445, and it was only there for a little bit, and then it turned. I haven't had a chance to check it this morning yet, but that's what we're looking at now. So we're starting to get a little bit of some more buying in the market, which I certainly would like to see. I'd love to see that S&P get up around that 1900 level one more time. I think that would give us a chance to put on some low risk shorts. But how far the rally is going to extend, we'll have to let the trading gods decide. We did hit the 1124 level in the gold last night, and that was a minor retracement of some kind. I want to double check silver here because I'm setting in for John this morning, and I didn't have a chance to update it quickly. Yes, we did get down to that 445 level, and now we popped up. We're trading near 1459 now in the D silver. So we didn't stay below that 61% retracement for more than just a few minutes. So this is what we're watching. Okay, we'll take a break here, and we'll be right back after these few words.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
Today, it's hard to tell if the economy is coming or going. Regardless, I want my money going in the direction I choose. If that's your stance as well, then you want to know how Everbank can help keep your money thriving just the way you want. Is growing your money a priority? Everbank is committed to a yield pledge promise to pay high yields on your checking, money market, and CD balances. Looking to diversify? Everbank ingeniously developed accessible ways to spread your money around the world into foreign currencies and even non-FDIC insured metals. And when it comes to your wealth, they bring a highly experienced and global perspective to help you manage it. Everbank's financial philosophy flies in the face of the status quo. They believe your money's performance should not be determined by today's economic circumstances, but by the drive to rise above them and create opportunities that favor your objectives. If that excites you like it does me, visit everbank.com/TFNN to find out what they can do for you. Again, that's everbank.com/TFNN. Visit them today. Everbank is a member FDIC and equal housing lender.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartleys, ABCs, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com. Larry Pesavento has just started his brand new service, Fibonacci 24/7, and he's already delivering content to his subscribers on a daily basis when the market's opened and even on weekends. Each Monday, you'll receive Larry's written report that provides detailed commentary and a summary on the charts and videos that Larry sends out. And throughout the week, when warranted, Larry will send out via charts or videos or both the key markets that he is watching during the day. This will be up-to-the-date active trading information that will help you in your daily trading. In Larry's first week alone, he sent out 25 charts, 6 videos, and a full report to his subscribers in just 1 week. If you're a technical trader that uses patterns and retracements to trade, then Larry's service Fibonacci 24/7 is something that you must try. Right now, new subscribers can get a full 30-day money-back guarantee. With nothing to risk, sign up now to Larry Pesavento's Fibonacci 24/7 by visiting the front page of TFNN.com under Trading Newsletters.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Okay, we're back, folks, and we've had a question from someone here in the den, Tiger Den here at TFNN, and that's regarding, how do you trade some of these, really strong trending markets like we had yesterday, with the Dow down 350 points and the NASDAQ down 120 and stuff like that, and really it's a little difficult because you don't see a lot of the up and down move that you might see during a regular trading day, because usually the market's on both sides of unchanged to positive, quite a few times during a normal trading day, but on a real strong trending day, it goes in one direction. Now, the key is to watch, if you'll take a look at this DAX chart that we have posted here in the TFNN. If you'll look at the first move, you'll see the red box there that I've marked in was the first counter trend move of the morning. And then watch that, because that move is going to repeat. And as you can see, this move repeated 4 times during the day, where the market would rally up to almost exactly, the same amount. And I believe that was right at about 80 pips in the DAX, and then it would proceed to go down and make new lows. Well, this morning, it gapped down and then rallied to the exact 61% retracement of the high we made yesterday. So it's still in a downtrend. All it did was make a 61% high, and then it sold off, and now it's just bouncing around in between those numbers. So it's showing that there's probably not going to be a strong trending day in the DAX. So you'd go back to using, your patterns and your Fibonacci numbers. But when you have a really, really strong trending day, those are the kind of days where you want to watch what's happened after the first correction. And believe me, the market repeats over and over again every day. What Dr. Andrew Lowe taught us about this in his book, The Non-Random Walk Down Wall Street, is the market is chaotic, but within the chaos are these non-random patterns that repeat, and they are predictable. Within limits, of course, but they are predictable. And he was referring to the same chart patterns that we look at, double bottoms, double tops, triple tops, triangles. I've given them some exotic names like butterflies, Gartleys, ABCDs, whatever you want to call them. But they're nothing more than chart patterns based on a high, a low, and a high, a triangle, or a low, a high, and a low. They're all triangles, and that's all you have to remember is to try to put these together to give you a spot where you have a very, very low risk, trading opportunity. One of those, I believe, has presented itself possibly in the Canadian dollar, because we went up and we made another high up there at that 134 level. We went about 8 pips higher than the previous high we made last week, and we still haven't, gotten above that. We're trading below that high right now, so keep an eye on that Canadian dollar, because it still has a chance, for a major high in here. Now, there's one other question that someone asked, and that's about gold. Am I bullish on gold? Yes, I am bullish on gold. And what I'm interested in is let me turn this phone off. That's Janet Yellen again. And I'll have to get back. Well, she must be in a hurry today. I can't turn that off, unfortunately, so it'll go off in just a minute. That's my personal cell phone, and it is my good friend Byron Tucker calling in. He'll have to wait. I wanted to show you the chart of platinum, folks, because it is extremely interesting, because we're getting really close to some really important support here at $900, just a little under $900 an ounce in platinum, because that would complete down here at about 885. That might be enough to turn the gold market. But you see, platinum continues to go down, whereas gold and silver have held up above those levels. So platinum still seems to be a little bit weaker, but it still has some type of a chance down here because of the butterfly pattern that we have forming, along with the multiple ABCDs and expansions. It comes in right around 885. I haven't had a chance to check the platinum this morning, but let's just do that right now since we're on the air here. And I'm in control. Since John's not here, we'll just pull up the platinum and we'll see where we are, and we'll find out if we made that key level or not. We're looking at about 885. Oh, we got pretty close. We got down to 899 last night. So, oh boy, that makes the ABCD pattern perfectly. Wow. Yeah, that ABCD pattern that we just put in there, the D point comes in at 903, and we're trading at 913 right now. So that could be a potential pretty good bottom in the platinum market, but it's still a little bit early. But I still like gold and silver, and the only reason I like gold and silver is I know that something bad is out there, and when it finally comes to the point where this all comes to fruition, whatever happens to be, I want to have some gold. I always have gold. I mean, I've been buying gold since we were able to buy gold, way back in 1972. And I still have, silver that I bought, way back in, but that's not a lot. But, it adds up. So we'll see. Anyway, the the two outliers that I mentioned before, Volkswagen, Deutsche Bank, quantitative easing. There's so many bad things out there that this is just really we're looking at something really nasty, boys and girls. There's no other way you can look at it. Just look at the charts. The charts are telling you there's something not right, and the breadth of the market just continues to look like it just looks worse. I mean, every day. I mean, you get more new lows than new highs, and if we saw anything that would tell us that the breadth is getting ready to change a little bit, I would be in there looking to buy, just if nothing else, for a good rally. And we might get a 2 or 3 day rally out of this, but at any time we can just stop and roll over because the market's self-correcting all the way down. And by that I mean it goes down and then corrects up and goes down and correct up. It's not straight down or straight up like we had on the way up. We had just straight up. There were virtually no corrections. Then there'd be a small correction and then higher and higher. Well, it can go down the same way, just drops. And believe me, gravity is a great equalizer. As we all know, as we get older, that things follow their own weight, and that's something that you have to be very, very aware of when you're doing this. So just be careful for your keyhole plan. What do they call them? What are the IRAs or whatever they are? Just be real careful up in here because we're breaking some real serious support in some of these things, going below those August lows. And once we go below the October low and then in the S&P index, which we haven't got to that yet, the October low of last year, we've already done it in the New York Stock Exchange index. I mean, we did that a long time ago, and then we had to rally back. I mean, this market looks so bearish that it's really difficult. And believe me, I'm a technician, folks, so I'm not seeing the things like the other people are seeing. I'm just looking at this from a spot of watching where things are supposed to be going, and that's basically it. Now, I've had another request to take a look at the emerging market index that we follow. And as you can see, we had a nice little ABCD pattern rally up into that September 17th high when we had Mercury going retrograde, and then we've already taken out the lows of that previous week, and we're almost ready to take out the lows of $31, which will break us below the 61% retracement on the long-term weekly charts. And that, again, it will also be extremely, extremely bearish. So keep in mind that it's not just the United States, it's all across the globe that we're seeing this. And there's just not enough room to people get out of the market all at once. So this is going to be very interesting how this unfolds. Yesterday, I posted a chart that got a lot of interest, and that was a chart of Wynn casinos. And as you can see, this gives an idea of, since a lot of their income, I believe more than 50% of the Wynn comes in from China. And as you can see, what's happened, it just keeps getting weaker and weaker and weaker. Somebody on the inside has been selling this stuff because they realized that we were trading up and around 250 in April of last year, and here we are in September of 2015, and we've given back about 90% of the whole move, and we're way below the 786, and it just keeps getting weaker and weaker. That doesn't mean you can't get good bounces. We've had some 10% rallies in this thing over the past weeks, and that's all it is. It's just a quick rally and then boom, down some more. This is this gravity approach, and you've got to remember that when you see this, you've got to be prepared, because this is what did this old cowboy in back in 1974. I thought I was the real cat's meow and knew everything that was going on, and then I got caught in the October crash of 74, which in reality turned out to be the best thing for me, because it forced me to understand the error of my ways. It introduced me to the Gartley book. And then I became a technician after that, because I used to look at the fundamentals up until that time, and I used to believe them. But now all I believe is the charts, because if there's more buying, prices are going up. If there's more selling, prices are going down. It can't be any easier than that, boys and girls. That's what you got to look at. Whether you're using a 200-day moving average, a 50-day moving average, any of those things could easily work for you as long as you use it in conjunction with a little bit of common sense, because that's the key to what we're watching here. And something is not right. There is really something not right with some of the things that are going on in the markets these days. Now, I've had a request to put the chart of the Canadian dollar in one more time, because we did go back up and we made that made another new high today by about 6 pips above the old high. And right now we're trading just under the 134 level, which I believe is area where we're going to come into some major tops. So we went back and matched the high of last week, took it out by just a little bit, but didn't go, going far above it. So that's really, what we're looking at. Now, we have a lot of earnings and stuff coming out this week with things and news on Apple and stuff like that. And the Apple had a monster iPhone sales, and you saw that the stock was down. That's basically because the market has discounted all of this stuff, folks. And that's the bottom line of what we're watching here. So keep in mind that just because the news looks pretty good doesn't mean these things are going to go higher. And by the same token, maybe I'm totally wrong, and maybe the problems at Volkswagen are not nearly as bad as the stock price is telling us, and maybe the problems at Deutsche Bank are not nearly as bad as the stock price chart is telling us. But just looking at those charts and going back historically, what we've seen is this is not good. I mean, it really isn't. I mean, this has caught some people by surprise, and I think it's going to end very, very badly. And this the chart of Deutsche Bank looks very similar to the old chart of Lehman Brothers. I searched everywhere to try to find one of those, and I know I kept them there in Tucson. They're not here with me in Philly, and I really would like to show you that chart, because I remember it so vividly. I believe it was around $29 a share, as I recall, that if it got below that, there was just nothing else there. It was just air, and boy, that's exactly what it had in it, was air, because it went to zero. So whether that is in history or in the making again or not, I'm not sure, but it certainly doesn't look very good. And if you're a Deutsche Bank holder, be sure to prepare yourself against something, really, really sinister happening out there, which you can certainly come into. That's not a problem to realize that under any stretch of the imagination. Okay, now we had one other question, and that was about the, just one second here. I've got to get this turned around. It's about the British pound. Okay, this is just one second here. Let me get the British pound up here, because I think this is a, where is it? Oh, Larry. This is the one I want to show. This is the one from my compadre, Jim Bartolioni, and this shows that the long-term, structure in the pound says we're going to drop down another 1,000 pips from where we are right now down to that 141 level. And as you can notice on these triangles, they're all related to time, and that's the type of work that Jim does, and that tells you that the amount of time up in the move versus the amount of time down in the move will be equal. That means we're not going to be bottoming for at least 1.5 months in the British pound at probably 1,000 pips of where from we are now. So try to find a place to get short. We're trading at 151.40 right now, breaking down below last week's support. So it's telling us that the British pound certainly looks like it's under a great deal of pressure, and it wants to go, to go a lot lower. Okay, 877-927-6648 if you have any questions, and we'll see if that's going to happen. Oh, here's a question from Dan about the wheat. I'll put this up and we'll take a look at it, because I think we were watching this on Monday, We were waiting for wheat to get to 5.17. It only got to 5.15 and a half. Then it broke 15 cents. We're trading at around 5.05 right now. So I would expect the wheat to come back into that 4.88 level sometime over the next few trading days or maybe a week. And then we could look at it again as we complete point C again of an ABCD structure. 877-927-6648. This is Larry Pesavento for John Logan.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Hi, I'm Steve Rhodes, host of the Trader's Edge, heard daily at TFNN.com and author of Mastering Probability, a daily investment and trading newsletter service that I send out each morning by 8 a.m. My morning newsletter service covers exactly what the markets have been doing since last night's close, providing you with an edge on your trading day ahead. You get actionable trading ideas, including the exact entry, stop, and profit targets. Plus, I'll teach you the patterns and hidden market correlations that will make you a better trader. As a subscriber, you'll gain access to my 90-minute money management workshop, where I'll teach you the secrets that'll save your assets. The bottom line, I've got your back, including a 30-day money-back guarantee. See for yourself the type of analysis I provide each trading day by signing up for Mastering Probability today. With nothing to lose, this is an offer you should not pass on. Mastering Probability can be found under Trading Newsletters on the front page of TFNN.com.
Catch Larry Pesavento, a 40-year veteran trader. He uses pattern recognition, Gartleys, butterflies, ABCs, and Fibonacci in order to trade these markets. Trade what you see. Next on TFNN.
Okay, this is Larry Pesavento setting in for the esteemed John Logan, who's recovering, and he should be back in business hopefully next week. It's not easy when you have surgery, when you get over 30, boys and girls. So just remember that gravity works both ways, but as you get older, it only works one way. Okay, now keep in mind we've been talking about how the stocks have started to break down. We're having a little bit of a bounce back rally that is not surprising because we had the full moon and lunar eclipse on Sunday. That should have brought some type of a bottom in, and we should get a bounce of a few days. It might be 2 days, it might be 3 days. There's a possibility it could be all week long, but we're looking at this major bottom out here on October the 6th that should be pulling stocks a great deal lower. So if you come in and you see these markets reverse right away and start heading back down, you'll know that there's a big magnet out there pulling it to the downside. Now, there's a outlier event that it could possibly be a rally that'll take us into October the 6th. But I don't believe that that's the case, but it's certainly possible. And no matter what that is, we're going down, folks. Just look at these charts. Look at the breadth of the market. You don't have to be an expert technician. Just like my little grandson, he looks at these and he said, "This one's going down." And he looks at the other one and said, "This one's going up." I mean, you don't have to be a PhD. You just look at what's happening. And there's something wrong. Keep an eye on Volkswagen and Deutsche Bank. You don't necessarily have to watch them. I prefer you not watch the news, but watch the price of the stock. If this price of the stocks start to rally, maybe they've made some type of an agreement, and things are not going to be as bad as they appear they could be on the chart. So just follow that. We've had a pretty big move in Volkswagen, down 35, 36% in just a few days. Whether that's going to be enough or not, we'll have to wait and see. But it'll shake the rest of the world for sure, because it's the largest bank in Deutsche Bank's the largest bank in Germany, and Volkswagen is the largest employer in Germany, along with being the largest auto manufacturer in Europe, and their financial arm goes way out, because they take these loans, they give loans to people, and that's another thing that can cause some other problems that might happen. So there's some canaries out there in the coal mine, so just be careful, folks, because it can be a jungle out there, as they say. But right now we are in the midst of this little bounce, and frankly, I think somewhere around 1900, the S&P is probably going to run into some pretty stiff resistance, and we'll watch to see what happens with some of these. The fact that the Dow did stop at the 786 yesterday makes me think that we're going to get some type of a little bounce just based on this lunar eclipse and full moon that we had on Sunday. That effect usually lasts anywhere from 2 to 3 days, so that would take us into Wednesday, and we'll see if the market is going to hold that level. But 1900 would be a pretty significant resistance, I believe, in the S&P 500 futures, and I believe 16,100 in the Dow Jones would also be a pretty stiff resistance. We were down 350 points at one time in the Dow yesterday. So far, we're up about 70, I believe. So we could, at least that's not even a 382 retracement back of this last move. So we could take it all back. We could be up 300 points in the next couple of days, or we could go straight down from here. That's what it looks like from the cheap seats. Live every day in an attitude of gratitude, and may God bless. And I'll be back with you for my show in about 10 minutes.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman wave sequence. Using the Chapman wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
This is TFNN.